Yeah, I'm excited to be here. I'm excited to share, I guess, the journey we've been on with CrowdProperty introducing it to Australia. Is the journey I've been very much on with MGI, got them excited about the proposition and what we're trying to achieve here. And it's a reason, I guess, we're here tonight. And thank you very much for the warm introduction and background to it. So I'll get into it. I think Tony's already described a little bit about what we do. So this is what we do. We're really all about solving project finance for small-scale property developers. And what I want to talk about a little bit tonight is not just what that means for property developers, but why that's an opportunity for you as wholesale investors. And the opportunity really lies here. So we provide opportunity to invest in first mortgage security of small-scale, high-quality residential property projects. And these are just a selection. The ones on the bottom of the screen you'll see here are ones we've already funded here in Australia. Some are quite local, down in Salisbury Heights, might be a suburb which is familiar to some of you. The ones at the top might be less familiar. They're from our partner in the UK. So CrowdProperty originated in 2014 in the UK. It's now funded something like £500 million in project loans. They launch around about 3 of these project loans a week on the platform, and those 2 are just a random, or 3 are just a random sample of projects which get launched on the platform. For some reason, 10 o'clock on Wednesday they get launched, and by 10:01 there's over 2,000 investors have come into each project loan and closed it. So if you look at those times there, you'll see 53 seconds, 22 seconds. It's quite a phenomenal amount of interest we get in these project loans, because there just aren't really opportunities like that out there for, I guess, anything other than institutions which have traditionally played this role. So the canny thing which Michael's done here tonight is to introduce this to you guys here, because we don't have that problem here yet. There are too many investors trying to get into each project loan, so there's still plenty of ample opportunity. And the other thing I would say is, don't worry, you get more than a minute to make a decision. So you'll find we're very transparent. We'll go into that about all the work we do before a project goes anywhere near our platform, and the kind of information you get to see on that project before it goes live. So every business should start with a pain. Otherwise, we don't have a reason for being here. And I think our reason for being here is the banks are really failing our small-scale property developers. And this in turn presents an opportunity for us in the room as investors, looking at where we allocate our self-managed super funds, as we can provide that opportunity. So, yeah, the lack of trust is too far gone with many of our banks. The process is slow, it's confusing, it's not transparent. And above all, there's really lack of access to property experts, people who actually understand the projects, the developments which we're trying to deliver. I will get to it. These are just some of the quotes which have come up from our borrowers, from people we were talking to when we actually launched in the world where we weren't able to get in the same room together. We were online. These are probably some of the more publishable ones. The ones I quite like here. The banks might look cheap, but it's a higher price you pay in the end. Nobody understood property. I hate surprises, there are many, and so on. I don't need to go through those, but these are the pain points effectively we're trying to solve for. So, in its essence, it's about property finance by property people. And this is the concept I really fell for with CrowdProperty. So, ultimately, what we deliver for our borrowers is speed, ease, certainty, and that property expertise and transparency. There's no hidden fees here, so there's no last-minute changes. It's all about being transparent, and that works on both the borrower and investor side. So, on the investor side, there's also more pain points we can solve, and I think Tony's probably alluded to some of those in the presentation. So we know that property is an attractive investment. It's always traditionally outperformed cash here, but investing directly in it is expensive. There's high capital costs involved. You're tying it up for long term. and there's potentially equity risks in it. So what we're offering here, I guess, is that alternative. And that's even more compounded for, I won't go over this again, but you know, that requirement which Tony was talking about before to diversify and self-managed super fund, it makes it even more acute if you're thinking about a lot of people who've got into just perhaps investing into one property within their super. So as investors ourselves, we understand security is a priority. So we always invest, we always take first mortgage security against all of our projects. You'll see other alternative investments out there, and sometimes they can have higher, more attractive returns out there. You've just got to look at where they sit in the capital stack. Are they offering that first mortgage security, or are they looking at second mortgage, mezzanine, equity type opportunities? Now, there's a whole raft of things we do here at CrowdProperty which goes over and above first mortgage in terms of taking security, and that can be around personal guarantees from developers. We always put in a tripartite agreement between not just the developer and the lender, in this case, but also the builder as well, which is very important. We do the stage funding of works. We have independent surveyors going out and assessing projects to make sure they're actually on track. But I'm going to leave that for Daniel to talk about a little bit more later, our property director. So first mortgage secured investments have been around for a long time. There's nothing new about this. You know, traditionally it's been institutions doing it. There's also been individuals who perhaps had the wherewithal and the time on their hands to do this. But as I kind of say to those people, well, how do you go about selecting? You know, if you're thinking about an investment, you're thinking about potentially partnering with a developer, how do you go about assessing that developer? How many of those do you need to meet before you want to invest in their projects? How do you assess their project to make sure that that project's actually going to deliver? So there's a whole lot of things you've got to think about before you can get into the mechanics of how do you actually you know, get the first mortgage sorted out, the stage of drawdowns, making sure the loan actually gets repaid at the end of the day. And I guess that's where we come in. So it's not been a surprise that first mortgage investments have been the preserve of institutions previously, but when you actually look at banks, they have extremely high cost bases, and that results in poor returns on the other side of it for investors. So if you look at the research, this came out of McKinsey in the US. You know, you look at this, and this is based on lending at a rate of 10%, and when you take out all their costs, there's only actually a fraction getting back to the investors at the end of the day. When McKinsey compared that with a marketplace lending model, you can see the fundamental cost advantage means a much better deal for all here because of that less cost base. You know, we don't have branches to support, we don't have legacy technology in there, so that actually means we can pass on more of our returns back to investors. And part of this is because the traditional value chain here has got a lot of people in it, and that's fair enough. They've got businesses to support and they've got profits to make. I guess the model we introduce through marketplace lending is we build a direct relationship with both our investors and, importantly, our borrowers as well. So we're actually cutting out a lot of those profit pools in the middle. It's very important that we build a relationship with the developer because we want to understand all about them, not just their project, but who they are and what their motivation's for. So, again, we have fundamental efficiencies, which again allows us to pass that on to our investors in terms of their returns. So, who invests in marketplace lending? I don't know, is this a concept just new to people? Have anyone heard of this kind of thing before? Yeah. Some nods, some not. Okay. Well, it's surprisingly enough, it's not those early adopters, which you might think it is. It's not the kids who are hunting on crypto at the moment. So when the University of Cambridge did some research in the UK around the alternative finance market, this is actually what they found in investing. And you see those deep green bars there, they're actually the over 55s. So, and after that, it's 35 to 54. So it's people who are looking for that first mortgage security, that capital preservation, but with better returns. So a little bit about CrowdProperty. And importantly, this is all about, it's a people business. Yes, I can stand here and talk about the technology which underpins it, but ultimately it's about people, it's about property people lending to property people. So Tony Zilli, you've already met. Tony and I worked on a previous management investment scheme previous to this. But on the other side of it, we've also got our borrower team led here by Daniel Heaton, who we'll be talking shortly, is a property director, who's got his own developments, many of which are actually very close to where we are here. And we've also got Alan Wang, who works in our property development team. He's an architect by background. So we bring, I guess, that property experience. And that is the fundamental difference, I think, in our business. So where Tony and I were working before, when we were talking to property developers, it was all about the term sheet. Here it's actually about how do we add value. Yes, we do extensive due diligence while we're talking to you and understanding the project. But it's actually about, assessing not just does the project stack up, does the financials stack up, what's the term sheet look like. It's actually more about fundamentally what are people's motivations and why they're doing the project. So having people who've walked in their shoes before not only helps in that due diligence process, but it also helps throughout the length of the project to make sure that the project's a success, the project gets repaid, our investors are happy, we're happy, developers happy, and round we go again. So that's essentially at its core. And that's reflected in our UK team as well. So we've got some great bench strength there with those who sit on our investment committee, like Andrew Hall, who's got 35 years grey hair experience in the industry himself. And then we've got a whole team which sits underneath them, and they're all qualified surveyors. They've all been in the industry for a long time. And our team, I think, probably draws upon them weekly in conversation. It's very much a team game. All of that, they've been honing into processes which we're drawing upon here, all the IP, very much the due diligence. We could bore you with the 57 steps which are in this, fed by many data points. We're now feeding in obviously the Australian data points. But all this is fundamentally about talking to the borrower. So right from that top up there, right through the investment committee down here, it's understanding not just, as I said, how the project stack up, but who we actually deal with. So, the technology we can talk about as well. These are just some screenshots of it. Anyone who's familiar with internet banking will be familiar with what our platform offers in terms of the dashboard. You can go in and look at individual project loans. You can look at your capital interest when it gets drawn down, repaid. You can also go onto the site and look at all the information on the projects. We make all that transparent. All the work we do gets to go up onto the platform. You can browse it almost like you do with realestate.com.au. All the information's up there, including we do a webinar with the developer so you can get to understand who they are, who's in their team, and get a feel for them as well. So again, transparency is kind of at its core. So what are the benefits for investors? Well, you could do this yourselves, but we've effectively done all the hard work for you in terms of all that due diligence which goes into it, looking at all the, to give you an idea, UK's seen something like £6 billion worth of project loan applications now, and they've funded less than 4% of those. And when I challenged kind of the team, as we came up to a year anniversary here, we've seen a much smaller number. It's still a pretty big number, probably something like coming up to 400 million in project loan applications. But following those same processes we've talked about, we've only funded just under 4%. So that selection process is kind of key before a project goes anywhere near the platform. You'll see unique projects. So we directly originate all our projects. So you won't see these projects anywhere else. And from the investor side, there's no overheads. So it's not like if you compare it with the direct costs of trying to invest in property, we have none of those costs. We don't charge any fees for anyone investing in the platform. And we touched upon the point earlier of the importance of diversification. Obviously, you don't have the same sort of capital outlay here. So it enables you, from a minimum investment of $10,000 into a project, you can actually diversify very easily across multiple projects. And to tell you how that plays out, the average investor in the UK has now been in over 70 projects. So if you think first mortgage security, sensible LVRs on value-adding projects which have been through all that due diligence process, and then imagine one of your projects kind of maybe doesn't pay back the interest. That, if you're in over 70 projects, that probably looks more like a rounding error in the end. So we're not quite at the 70 project stage, but you get the feeling of the concept. And we've got plenty more things coming. So how do you get involved? You can either come in and say, check out the project, see what's coming live, what's coming online, invest in a single project, in the investment in what is first mortgage secured project, or you can come into our new partner fund. Now, again, that's really taking the feedback from people saying, I'm busy now, I don't have the time to go in and look at every single project, but I trust in you guys, I trust in the process, and I'm interested in investing in the fund. And the benefits of the fund is that you're not committed for the full length for a project. Typically a project averages about 14 months, and the capital and interest gets repaid on the first mortgage. When it gets repaid, it's a debt, it gets repaid at the end, and we distribute that back. So the alternative of the fund is actually we're able to make quarterly interest repayments. The minimum term commitment to the fund is only 6 months, and you can invest from $25,000. So everything else stands, so you're still investing in the same great projects which have been through the same due diligence process. But it enables you, by investing in the fund, to diversify across all projects as and when they come up on the platform. So, in summary, we look for strong securities, investors ourselves, always first mortgage, but we go beyond that in terms of looking at personal guarantees for our borrowers. We manage the whole stage funding of drawdowns. We also go through a process of engaging independent monitoring surveyors to make sure projects are tracking as they should be, and our team actually evaluates those reports as they come back. So it's a great way to diversify. You know, if you're worried about that concentration risk, this is a very simple way to diversify, but still getting to scratch the property itch if you're interested in property. And as I said, there's minimum overheads in doing this. It's very simple to get on board, and you will see those projects through our direct origination, which you won't see elsewhere. So yeah, we've got a very strong pipeline of projects coming up. I think that's probably looks more like 400 million now in project loan applications now. It's in the latest numbers, but it's ever growing. We've got new projects being introduced to the platform all the time, and we've got not only the track record, I guess, of the UK. We've been in operation since 2014. They've got 100% track record on paying back their principal interest returns. Here we operate through a managed investment scheme, so even if you've never heard of CrowdProperty, there's another layer of kind of protection behind that. Is all the loans are actually run through an independent trustee who are called Key Fund Services, and we're looking forward to scaling the opportunity with, I guess, the help of everyone in this room and other investors who want to get behind us. So yeah, I think with that I might give you the opportunity to talk to Daniel, our property director, about some of the upcoming projects which you can get behind, and he can talk a little bit more about how we select those projects to go on.
Good evening. I wanted to just run through our selection process of how we determine suitable projects in our pipeline. But a little bit about me. My background is in business and finance. I've helped grow and advise businesses across healthcare, technology and real estate. I've been investing and developing property, a lot of which are in Adelaide since 2007. Roughly around about $45 million small to medium projects ranging from 1 to 2s all the way up to mixed commercial, residential projects as well. The thing that I utilise in my ethos is to build relationships with people. Yes, it's about property, yes, it's about bricks and mortar, yes, you do need bricks, yes, you do need structural steel and the timber. But it's about the people that you're dealing with. And what I find is there's always a story behind the person of why they're doing their job. And it's that relationship that you build that you develop over time that's valuable. And when you run into trouble, that's also the relationships that you can lean on, whether it's when the time's good or when the times are not so good as well. So that's what I try and carry through to CrowdProperty in assessing deals as well. So how do we actually select the highest quality projects for us to invest in? We've seen that slide before where Dave talked about being on senior debt. Now, the riskier you go up on the curve of the capital stack, the higher returns you'll get. But where we're sitting at CrowdProperty is the safest at senior debt. So what that means is our funds actually go into a project last and actually come out of a project first. I just want to touch on some of these points here on why we need things like tripartite agreements with builder and developer. So in the rare circumstance that a developer becomes insolvent or falls over, same with the builder, we have the right actually at CrowdProperty to step into a project. And if we need to take over the project to complete the project. The reason why we want the rights to be able to do that is the best chance of getting your money back from the project is when the project is complete. It's pretty hard to sell a half-completed house, for example. We are very heavy on intercredited deeds to make sure that subordinated and junior debt is where they need to sit, because we need to have the rights to the first mortgage and to have rights to step into a project as well. And all of our projects are funded on a drawdown on arrears. So that means they complete up to a certain point. We're sending our quantity surveyor to make sure they are built to that value, and then we forward pay them. We don't prepay any parts of that construction, if that makes sense. Dave's touched on the 57-step process. I won't go into that, but what I'd like to do is expand on one small section, which is the appraisal process that we do. So it's pretty multifaceted, it's pretty detailed, but this gives you some insight as to what we do. Market data, so we look at transaction volumes, we look at transaction value, so how much stock is turning over in that particular suburb, what are the similar properties selling for, but it's also aggregated by type. So for example, it's very different comparing a unit to a terrace to a townhouse, for example. We look at third-party references and third-party data. We look at things like Real Estate Investor, we look at Department of Transport, DIPT data, we look at Land Titles Office data, and we always get a third-party independent valuation on every single project. And the reason why we do that is because it's their role to make sure that the deal stacks up from their perspective. It's all good for us to say that it's there, but their role is to ensure that it applies an extra layer of research to make sure that it does stack up. So they'll look at the valuation as is before the development, they'll look at the as if complete valuation once it's done, and they'll even look at things like rentals. So as a contingency plan, if a developer wants to hold those units, what would that return in today's market? And then we do some detailed due diligence on the borrower themselves, why they want to do the project, how long ago they bought the project, their credit, their checks, and so on and so forth. And also, this is an important one. The reason why they got into the project, is it for yield when they hold onto the project to refinance out, or is it to sell on to the open market? And if it's to sell, to make sure that they have a good assessment of who the end buyer is, and to make sure that that has a good market fit from before they even break ground. As we touched on earlier on, there's about 100 years plus of development experience in-house. That's not me solely, that's also including the UK. And we've got various ways that we can look at maps and overlays to ensure that we're not being caught out on anything, bushfire zones, flooding, etc., etc. We also look at resilience data, so we look at 20 years of data on what the biggest drops in the median sales price for that particular area. So in case we hit those headwinds to ensure that we are in a deal where it can take the drawdowns in the pricing. We even look at demographics on the suburban street level as well, so we'll have a look at things like incomes, we'll have a look at demographics right down to the street, not just the suburb, and also legals as well, including first strike mortgage. Yes. So this is the funnel. So at the start here, that's 100% of our applications, and as you can see here, the actual number that we fund here is around 4.2%, and that's in line with the UK as well. So from the time the borrowers apply to going through the first application, we actually reject about 70% of projects. And there could be any number of reasons. It could be that the product isn't the right fit, the developer may not have enough experience in the project, or it could just be not enough equity in the project itself. So what we actually try and do is put it on its head and say, look, how do we reject the project earlier on to ensure that the deals can make it through the rest of the due diligence process. Who agrees that we're in a bit of an uncertain market at the moment in the real estate? Yep, lots of nods. Good projects have inbuilt contingencies to allow for market swings. Now, we'll just want to briefly talk about what some of those contingencies are. So the first thing is to ensure there's enough profit on costs in the deal. So let's say a developer starts with a 20% profit on a project, market swings, build costs increase, and sales decrease. That could come down to 15, 18, 14%. It's not the end of the world. But if they start very low with very skinny margins to start with, that could turn into very quickly. The second part of that is changing the marketing or sales plan if they're looking to sell a project. So what that means is that developers could potentially put projects onto the market earlier to capture some of the sales from that respect. So they're not taking the full force of the downward curve in the market. And the third thing is actually quite counterintuitive, which is counter-cyclical buying. So whereas 6 months ago you may recall the craziness in the market, that's certainly come off now, and we're actually seeing some developers getting some really good deals, negotiating settlements, etc., to allow for the next upswing in the market in the coming years. And remember, these projects do take anywhere between 6 months to 18 months, so counter-cyclical buying by the time the product is ready to sell. That could be a very different market that they're operating in. Is it okay if we go through some example projects? So this one is one we settled about 2 weeks ago. 2 weeks ago, in Rowville in Melbourne. Absolute lakefront. There's about 25 properties that face the lake. Jan, the developer, has lived in Rowville for over 25 years, and she's doing a renovation on this particular property. Really good bones, but needs a fair bit of work on the property. Some very basic numbers, very quickly. She bought the block of land for 1.62. She'll do a $200,000 renovation on the property, and she'll put it back on the market and sell for around 2.2, inclusive of GST. That figure is exclusive. Now we're loaning in total for this project 1.334 million. Now, when you look at that, the LVR on that is 67 going in, then 70% going out. If you do some numbers on that, what it means is that the market has to turn against you around 35% before it starts to affect interest in your capital. So 35%, that's a huge swing in the wrong direction. So that gives you an extra layer of security and buffer for the deal. And that's why we don't exceed the LVRs that we do on projects, just to ensure we have that extra buffer. This is one that we looked at probably 2 months ago in Surface Paradise. Experienced developer, beautiful townhouses that are in the that are overlooking. Can't see it there, but you've actually got some water views from that point. Very roughly, some numbers here. She bought the block of land for 1.3 million. She did build 3 townhouses at 2.3. She sold them for over 5 million as a cumulative on those 3 townhouses. So it's a fairly high end. I'm sharing this not as a deal that we did. We actually didn't do this deal, but I'm sharing this because the maximum LVR that we were going to go to was 67%. Now, the developer needed around $600,000 of equity in the deal to do this project. She had raised about a quarter of it by the time we were ready to loan her the amount. And she said, can you raise that to 75? Can you raise that to 80%? The answer was no, because that would put funds at risk. So we, despite being a $3 million loan, we actually didn't do that deal for the simple reason that she didn't have enough skin in the game. So it was a really good project. It looks good. The numbers stacked up, but we did more skin in the game. And that might come back in 6 months, in 12 months, but at the moment, that's not a project that we're funding. Just very briefly, some other projects that we've got coming up. Ockenflower in Queensland. So this is a beautiful heritage property that was on the left-hand side of the block of land. In order to take advantage of the views, what they did was actually, they couldn't demolish it, so they had to lift it off the stumps and plonk it on the other side of the block of land in order to build the 5 residential apartments behind it. A beautiful renovation, and because of that, the uplift of the value, she basically got the back of the block for free. What we're doing is we're loaning her $760 to start with, in order for her to settle the land and also start construction on the back. And that'll be 18 months to complete. Georgetown, Tasmania. Georgetown, Tasmania? Yes, okay, great. About 40 minutes out of Launceston. Now these renders are really good. This is actually very, very, very basic. But that suits the area, right? We're not going for high end, we're going for very, very basic. What the developer is doing here is he's developing 4 of them, he's holding on to them for yield. And we said, why are you doing that? He said, look, because we've got less than 1% vacancy in the area, I'm going to hold these for yield, and he's expecting rentals to go up, rents to go up in due course as well. So that's a very profitable project for him. But we're loaning $700,000 there to him for the development. It's cheap buying in Tasmania, certainly in Georgetown. Brassel. Yes, that's right. So see the original house, which is there. So somehow, out of all that, they managed to carve out 15 lots out of that, including selling the original house. And they've got, I think, I want to say about 7 or 8 of them pre-sold already, so that de-risks the project quite significantly. You can see a lot of trees, and I didn't ask them how they managed to get that through council, but they did. So they'll get rid of all those trees. So apologies if anyone's against that. But certainly in this case, we've got a $3 million loan where they're building a road, they're building sewer, they're building civil works throughout, and they'll actually recoup a lot of the funds from selling the house itself, which is actually a very good thing. So the funds on that, the targeted return on that for you as the investor is net 8% on that particular project. Glenroy, so this is another project we've got coming up. This is a developer that's already taken out a loan with us. They're copying that and putting that on another part of the same suburb. This may look like a duplex. It's not. It's got 6 bedrooms each with its own ensuite. It's got 2 living, it's a garage at the front, and it's going to be rented out per room. And the yield on that is ridiculous from a rental perspective, which makes it very profitable to develop. So the developer will hold on to both of those, refinance that at back of construction, and we're loaning her 1.26 million on that, which comes up to about 68% LVR on the project as well. Essendon, Victoria. These are high-end duplexes that we are doing. We are questioning on on this one the end sales values of the project. So we're currently about to do a valuation on these. So if they come in lower, we'll adjust the loan amount accordingly on these. But at the moment, that's sitting at a core $4.2 million loan for these very high energy courses. I think we're trying to fetch about 3.6 for each of these very high energy courses. And Lake Illawarra, New South Wales, not quite lakefront, but almost. The developer came to us with this sort of L-shaped land at the back. She looked at doing build one behind, that didn't quite stack up. She looked at building two behind. We actually did some numbers alongside her, and we said, look, why don't you just bowl out the house and build two side by side? In the end, it wasn't as profitable for them, but the risk was much lower because they've only got two products to sell. And if you look up and down the street, all the duplexes are side by side, not front and back. And so I think that's where everyone will probably head with that development. But it's just, talking it through, and sometimes, we provide that feedback to de-risk the project for them, which we're very happy to do. And of course, one in our own backyard, Salisbury Heights. This is a 20-lot subdivision, which is underway. Great views across Adelaide there. You can see that it's not greenfield. It's not in the middle of nowhere. It's right next to current development. And we like the fact it's hilly because you do get views. There are obviously costs involved with dealing with a hilly site like this. Lots of retaining involved. Lots of flood mitigation issues. There's retention right at the bottom of that site there. But that's all taken care of into the feasibility, and we're well underway on that one. Cool. So yeah, enough from me. If you'd like to see more projects, feel free to take out your phone and take a photo of that. And you'll be able to log on using your phone by scanning the QR code on that. Thank you very much.